Well, good afternoon, everyone. My name is Joel Schumacher. I'm an associate specialist with Montana State University Extension. And in the next 20 minutes or so, we're going to talk about managing non-agriculture based risks for farm and ranch families in Montana. So it's going to have some components that'll deal with insurance, health, life, disability, and also some other tools that we can utilize to manage that risk. So many of you are used to dealing with agriculture-based risk, and there's a lot of risk in agriculture. Anything from drought, hail, flooding, maybe the rains just came too late or too early and you couldn't get into the field, maybe an early frost, lots of weather-related risk that farmers and ranchers deal with. We also have production-based risk. So that could be maybe your wheat crops get some kind of disease, or maybe you have a pest problem, or maybe if you're a livestock producer, maybe you have predator losses. So there's risks that are associated with agriculture on that side. And then we also have market-based risks. So we obviously don't know what prices are necessarily going to be or what the basis is going to be for your crop at the time of delivery. So those are other sources of ag-based risk. And then we have management decisions that can also I'd say amplify or maybe minimize some of these risks that we just talked about. So, the variety of crops you're choosing to pick, how long until you replant an alfalfa stand, when you choose to fertilize, how much, whether or not you choose to, spray a crop for something, how you market it, what kind of equipment you're using. So all of those things I'm going to generally lump into agriculture-based risk. And we're not going to really deal with any of those today. But we're going to talk about some other things that can impact the success of your agriculture operation that come from kind of different aspects. So non-ag risks might be things like an illness that prevents you, from being able to work, an injury. Maybe this causes, medical bills that you're going to have to pay. Maybe you can't work for a few weeks or months or even longer. And maybe in the worst case scenario, we have a premature death because of some kind of injury or illness that takes place. So these things can all impact kind of the success of your ag operation. So how do we manage risks? So sort of in the big picture idea, there's a couple ways that we can deal with risk. So the first thing we can do is try to reduce or avoid that risk. So coming from just sort of a broad swath of things, that could include safe behaviors, things like wearing your seatbelt, having a farm safety plan, managing chemicals, in an appropriate manner, using equipment for its design purpose. That one, certainly we've all, especially on farms and ranches, maybe didn't quite have the right piece of equipment, so we may do with something we had, may not have been the safest way, but, managing those types of things is certainly one way we can try to avoid or reduce risk that just comes in. On the kind of the lifestyle side of things like, whether or not you choose to smoke, whether or not you choose to exercise, what your diet's like, those are all things that can impact our health. That ultimately then can, possibly impact our ability to work or the length of our life as well there. So then another thing that we can do is just try to simply avoid particular risks. Maybe you don't have the right equipment to put up your new grain bin. So you hire a company to come in and install that for you. Or maybe you don't have the right equipment to change the tire on a combine. So you hire a tire company to do that. So that's one way that we can take the risk of those activities and transfer them to somebody else by simply saying, I will just pay you so many dollars. You'll take care of that tasks, and then I don't have any risk associated with that. So that's another option we have to kind of manage risk, is try to reduce it or avoid it in some cases as well. It's not possible to get rid of all risk. So even if you've transferred some, you've minimized some, there's still going to be risk that's remaining that we need to be prepared for. So one of those tools, a lot of these risks come with sort of a financial price tag in some way. So if you're off work for 2 weeks, if you have to go to the doctor and pay a doctor bill, maybe you've, damaged your equipment using it in a way that maybe you weren't originally designed to. And it's going to have a price tag available to fix it or some time associated with it. So one thing is to have some cash available prepare for that. So if you have some savings, maybe you've got a line of credit, something like a credit card as well. So if one of these expenses comes up because of this risk, then you can go ahead and manage that. Maybe you can still make your loan payments if you don't have an income, for a month or something along those kind of lines. So that's one, is to have some funds available to cover when you do have a risk that pops up that you weren't able to avoid. And then second is to transfer risk to other people. And this is really where insurance comes in. And there's a lot of different types of insurance, but really what an insurance policy fundamentally is doing is you're paying a premium to give a big chunk of the risk of certain activities to someone else, in this case, the insurance company. So medical risk is obviously a really common thing. Health insurance is commonly available and most people try to get that. So if you do have a major medical expense or even regular medical expenses, you're not going to all of a sudden get hit with a $30,000 or $40,000 or $50,000 bill or even much higher. Rather, you're paying a flat monthly fee to protect yourself in case those kind of things happen. There's also some other tools that are available, health savings account, flexible spending accounts, Montana medical care savings accounts that all provide an opportunity for you to get some tax benefits on those expenses that you do have to pay. So there's a couple tools there that you can utilize as well. One of the reasons I want to talk about medical costs in particular is one, they can be very expensive. So the average in 2020, which is the most recent data I've seen, is about $12,500 per year per person in the US is the average expenditures. And that's everybody that pays. So that's whether it was out of pocket or your insurance company or if one of the government programs picked up. That's just the average of all the medical expenses somebody will incur. So $12,500, that's about $1,000 a month. You might say, well, that's manageable. But the problem with that is there's going to be a whole lot of people that have like $300 and $400 and $500, and then someone that's going to have $450,000. And if you're that person that has that big, very expensive year, that can just devastate your operation financially if you don't have some way to transfer the risk of that very expensive year transferring that risk to someone else. So that's why a lot of people try to have some type of health insurance to protect themselves from that situation. And if you're lucky enough to be one of those people that has low medical costs year after year, that's great, but you still have that protection available if you need it. Now, just a couple kind of background on healthcare spending in the US. So healthcare spending has exceeded GDP growth rate. And the GDP growth rates run around a little over 2% roughly for the last 20 years, and it's had some variations, but that's kind of a ballpark number. But healthcare growth, and let's talk about it in a couple different chunks here. So first of all, it was 5.8% from 2000 to 2010. That healthcare expenditures grew a whole lot slower from 2010 to 2019. Right, so we saw this real narrowing down in terms of percentage growth relative to, well, in general and relative to GDP. That gap was narrowing quite a lot. And then coronavirus came along in 2020. We had a huge increase in government expenditures on healthcare. A lot of that was research to try to find ways to treat and vaccinate folks for coronavirus. So you saw this big jump. So if we looked at that whole decade, it actually looks like our healthcare growth has gone up to 6.9%, which it has on a 10-year average. But again, notice it's really being driven by a 2020 increase. So I want to separate out those two trends, assuming that coronavirus is more manageable or less relevant here in the future. I may expect us to return to that trend that might be that we had from 2010 to 2019. So my guess is we're going to have a high number here for 2020, 21, 22, but then likely a much lower number returning to maybe some trend lines going forward after that. So I did want to point out that kind of fact that came in. All right, so just a little fact here. This is getting a little bit outdated just because I couldn't find the current data, but it's roughly in this ballpark of where people get their health insurance for Montanans here. So about 450,000 Montanans get health insurance from their employer group plan. So that could be the employee themselves. They may also be covering their spouse or their family as well, but that's by far the biggest group. Medicare, 21% Montana, is a little over 225,000 folks are on Medicare, and that's a government-based health insurance program for age 65 and older individuals. And then we have Medicaid, which is, and this one's about 260,000 people. This is primarily targeting lower income Montanans, and then we'll talk in a minute here about an expansion that took place too. And then we have what's called individual. These are just individuals, and this may be farmers and ranchers specifically if you're self-employed, where you go onto the healthcare exchange and just purchase a product individually, just like you would with car insurance. So about a little over 40,000 folks are doing that in Montana. There's another 10,000 that are buying it, not using the formal healthcare.gov exchange to purchase that. And we'll talk about some subsidies there as well. Prison population is always separated out in these numbers. And then uninsured Montanas, around 90,000 Montanans don't have insurance. So this is a couple years old, but the numbers probably haven't changed a great deal. All right, so this number is the most recent that I could find. This is the uninsured rate in Montana. And they do have a projection here for 2020. They weren't sure how many folks lost their health insurance during 2020 due to coronavirus layoffs. But the uninsured rate, you can see it dropped off quite a lot here from 2013 to 16. There were components of the Affordable Care Act and a Medicaid expansion kind of coming into play to see that landscape kind of change. And then we'd seen this slight increase in uninsured then drifting here or so over the last 5 years. So again, we may see some really funny numbers for 2020, 21, and maybe even 22. So it'll be kind of interesting to watch this, especially with the really strong labor market. We could see a lot more folks getting employer-based health insurance in 2022, even late in 2021 as well. But again, ballpark in the number, about 1 in 10 Montanans don't have access to some type of health insurance. So, and one other note too, folks that receive care through Indian Health Service or some of the VA systems wouldn't technically always be counted as insured. So some folks in this category may have access to some medical care through those programs, but it's not technically an insurance policy. Health insurance plans through this healthcare.gov that was part of the Affordable Care Act kind of got grouped into 4 categories, with the least coverage and the least expensive being bronze plans, platinum being the highest level of health insurance plans. We see a lot of silver plans being sold. Generally, higher premiums, more you pay each month, you tend to get better coverage, which means lower deductibles, lower out-of-pocket maximums. Now, I just want to give one quick example of a couple things related to health insurance. So what's it cost to get health insurance? You can go out, and I'll give you a website link where you can get a quote. Healthcare.gov is where you can do that. But I just picked a silver plan, which is kind of a common middle of the road plan with a $3,500 deductible and a co-insurance rate of 25%. You do have to pick a location. So I picked Gallatin County. And if you're age 30, your monthly premium is going to be $465. But many of us, as we age, start to have more and more medical issues. So our health insurance increases as we get older. By the time you're age 60, that monthly premium moves up to about $1,100 per month for health insurance for a single individual. This was for a male as well. I don't know if I put that in here. But over 80% of these projects are going to receive a tax credit from the federal government. So you're not going to pay this full amount. It depends on your income. Higher income levels receive less subsidy. Lower income levels receive the highest subsidy as well. The other thing I kind of wanted to point out was about this, where these income limitations come in and how much the subsidy will be and where you could find that out for yourself. So as part of the Affordable Care Act, kind of had a tiered system to get more Americans covered. Medicaid already existed for the lowest income Americans. We then had Medicaid expansion, which allowed the next kind of tier up of income level folks to get Medicaid coverage for those that wouldn't have been eligible before, but they're kind of the next tier up in terms of income level. And then if you're making too much money for that, you could purchase it at healthcare.gov and then receive some subsidies for that private policy that you that you purchased. So kind of 3 tiers there of different support levels. One already existed, and we kind of added 2 more to get more folks covered there as well. Most of the income and subsidy levels are based on a multiplier from the federal poverty limit. And for a family of 3, just to give you an idea, it's $23,000 annually is 100% of the poverty level. But they allow up to 400% of the poverty level in terms of still getting subsidies as well for these policies. So if you want to go to the Kaiser Family Foundation website, they've got this interactive subsidy calculator. You can type in your family income and see what your subsidy would be. That would be a little more accurate. But and anything below that 100% of the federal poverty level, you're going to be on Medicaid directly. So you won't need a subsidy because it'll become a whole package free thing. So free to the lowest income Americans, and then subsidized for the next group of income Americans as well. So that's kind of how these things fit together. There were also some changes with the Affordable Care Act that expanded health insurance in some other ways. One is it allowed children to remain on their parents' plans until the age of 26. So that got a lot of younger Americans covered as well, where they normally would have had to leave their parents' health insurance plans earlier. Specifically in Montana, the HELP plan is what we called our Medicaid expansion. It's what the legislature called that act. And this took place in 2016. There were some updates in 2018. But we do have eligibility for adults that are higher income than would have traditionally been eligible for Medicaid. About 110,000 Montanans are enrolled in Medicaid expansion as of December 31st. So it covers quite a lot. There are some copayments and premiums, but they are limited to 5% of your income. Now, with all of these plans, no matter pretty much how good your insurance is, or whether you're on Medicaid or Medicare, or if you're getting just privately paying, you're probably going to have some out-of-pocket medical expenses. If you work for an employer or your spouse does, you may have an opportunity to participate in a flexible spending account where they take money out of your paycheck on a pre-tax basis. It goes into an account, sits there. When you have an eligible expense, you can pay for it and then get reimbursed from this flexible account. And it saves you both state and federal income taxes on that. So that can be another way to manage healthcare costs. Health savings accounts, they're not tied to an employer. You do have to have a high deductible healthcare plan, and there's a specific definition of that, but it lets you put money into something. I'm going to say it's a little more like an IRA because it can be invested. But then when you have eligible expenses, you can withdraw those. And again, you can, it avoids state and federal income taxes on those amounts. One nice thing about a health savings account is you can build up a balance in those over a number of years. So if you're young and healthy and you have a qualifying plan, you can start putting money in intentionally more than you expect to have out of pocket payments and kind of save up. And then maybe if you do have a very expensive year, you've got a cushion there to manage that. Lastly, Montana Medical Care Savings Accounts, open to every Montanan over age 18. They only save you on state income taxes, but they operate in a lot like a health savings account. Open this account, incur an expense, you can withdraw anything you've deposited into there. It doesn't expire at the end of the year. You can also use it to pay for family members' medical expenses as well. So it can save you a little bit of money on Montana state taxes if you choose to utilize that program. Just a few details about these flexible spending accounts. Again, employer-based, have to be done through payroll deduction. Maximum amount for the medical portion is $2,850. You do not have to do the maximum. You could sign up for $50 a month if you want, or $25 a month if that's what you expect it to be. Only $500 can be carried over from year to year, or they can allow a grace period. So there is a little bit of a use it or lose it type thing. So you wouldn't want to put $2,800 into this account if you're expecting to have $300 in expenses. So it's a little bit of a planning game as to how much you put in, but again, it can save you on federal and state taxes. Health savings accounts, again, they allow a person to save for future health expenses. You can put in up to $3,600 for a person, or if you have a family version, that's $7,000. But you do have to have a qualifying high deductible health insurance plan. And these plans are not necessarily for everyone, and not every employer offers these. If you're purchasing individually, there is an option to purchase these, but your minimum deductible would be $1,400, and your out-of-pocket maximum can't be more than $7,000. So there's some rules specifically on what those are. You need to look into that. Most health insurance companies will clearly let you know if the plan you're purchasing qualifies as a high deductible health insurance plan. This can save you on state and federal taxes. And then lastly, Montana Medical Care Savings Accounts, open to all Montanans over age 18. $4,500 is a maximum contribution. You don't have to do the maximum, and you can carry it over from year to year. So very flexible, very easy to use, but only save you on state taxes. Montana state income taxes are much lower than federal taxes in most cases. So there is kind of a limited benefit on this relative to the other two. But this does provide a lot of flexibility. All right, let's kind of shift gears and talk about unexpected death, which certainly could also be a risk to your operations' long-term success. Life insurance is one tool we have to help manage that. Again, if it is a risk that we can't avoid. Median cost for a funeral in the US is just under $8,000. That's funeral with a burial. Cremation is around $7,000. Those are just kind of some national averages. That's certainly an expense we think about when people pass away, but really the big expense that most families are worried about is income replacement. So if you're a working member of the family and contributing to the family income, if you pass away, your paycheck stops. So that can be really what a lot of families are trying to manage, is how do the survivors continue to live maybe a similar lifestyle without the paycheck coming in from that individual. So, and then there's some other things. Maybe we want to pay off some specific debts related to the family farm, vehicles, whatever it might be. Or maybe you've got something you want to make sure you've provided for, child's education expenses. I had somebody tell me that it was their kids' wedding. They wanted to be able to provide a chunk of money for that. And those are some things that they were specifically wanting to cover as well. There's a couple ways you can kind of estimate those, and I want to talk a little bit about estimating your life insurance needs. So answering these questions is kind of, will get you to how much insurance, and we can go through a little bit of math as well. But how much income does your family need? And I would say, rather than how much you've been earning, to take a look at how much you've been spending. Because there are things that will go away when an individual passes away. Things like payroll taxes for that person, you won't pay those because they're not there. So looking at kind of where the money has been going as opposed to the bigger number on your salary might be better there. How many working years this person has left? So someone who's 25 may expect to work for another 40 years. There's 40 years of income that might need to be replaced. Someone who's age 60 may be expecting to retire in the next 5 to 10 years. The amount of income that they're expected to earn over the remainder of their lifetime is probably a lot less. And then how many people are you supporting with your earnings? If you're a single 20-year-old with no kids or spouse, maybe you're a renter, maybe you don't have much income replacement needs. There's no one depending on you. But if you're, let's say, 30 years old and have a spouse and several kids that are young and living at home, they may be expecting to rely on your paycheck to live their day-to-day life, for a number of years. And then, are you the only earner in your family, or are you a multiple income family? That can also factor into how much income needs to be replaced. I think it's easiest to talk about these in terms of examples. So let's just go through a couple of kind of simple ones. So we're going to have a married couple, no kids, both age 55. Husband earns $50,000 a year. Take-home pay is $37,000, again, because of federal taxation, unemployment insurance, retirement contributions, a health insurance portion that they've been paying. And some of those things are going to go away. So we're going to talk about the $37,000 that the husband was actually taking home. And this individual has $150,000 saved for their retirement. We're going to have the wife here, works part-time, earns $25,000 a year. Her take-home pay is about $18,000. She has about $25,000 saved in her IRA for her retirement. So what's the goals for this couple? So one, they want to have $10,000 available for funeral expenses, and they want to replace 10 years worth of income at 80% of their take-home earnings. Now, you can certainly go out, and I would encourage you to do this, to type in life insurance needs calculator. You can plug some numbers in, try a couple different ones. I'm not going to endorse a particular one. Usually it's a life insurance company that's providing it, but plug through one of those and see what kind of numbers it'll give you. When I did this, it says the husband came up with that they need $139,000. And the need was really, if we wanted to do 80% of the income plus 10,000, was 289,000. But we can also know that he's not going to utilize that retirement savings, right? If someone passes away, they won't have expenses during retirement. So the amount of insurance they need is only 139,000. So you may want to subtract out for some of those things like retirement savings that are now available to support his family's income level. The wife in this case would need 120,000. The replacement goal there is 145,000, but she has a lot less in her IRA that can be used to reduce that amount. So that's just one example of calculating how much life insurance this couple might consider. Let's change the story a little bit and say that they needed to replace 20 years of income. Maybe they're a little bit younger than we had talked about. Maybe they had expected to work until they were in their 70s. In this case, using the same methodology, the husband would need $300,000 of life insurance, and the wife needs about $200,000. So that is a really important number when you're calculating this, of how many years you're trying to replace that income. So the more years of income replacement needed, certainly going to be higher insurance needs. The more savings you've got, like the IRA in this example, lower insurance you're going to need. And then the more one-time costs, things like funeral expenses, maybe a child's education, that's going to increase your insurance needs as well. One particular life insurance strategy I wanted to mention, you hear this sometimes called laddering or layering policies. Let's just assume that we've got a husband here that needs, he's age 45 and he's calculated out, decides he needs $300,000 of life insurance. But every year that he works, going forward, is a year of income they don't need to replace. So if we think about 10 years from now, when this individual is age 55, they're going to have less life insurance needs than they have today, assuming everything else stayed the same. So what sometimes people do is they'll purchase a 30-year policy for $50,000. They'll purchase a 20-year policy for $100,000, and they'll purchase a 10-year term policy for $150,000, all on the same day. So if he does that, his coverage tomorrow is going to be $300,000. But at 10 years, that first policy is going to expire. If he chooses not to renew it, he'll just have the other two policies remaining, and he'll have $150,000 of coverage. Again, if time goes by and he hasn't passed away, 20 years down the road, the second policy would expire, and he would be left with just $50,000 of insurance. But that might be all he needs. So this is a way to reduce your costs. These 10-year policies are going to be cheaper, and still get that full coverage you've got. So this is called laddering or layering policies. There are other products, whole life, and in this case, the premium is going to stay the same for the entire course of the policy, which likely is your entire life. And then the premiums tend to be higher when you start, but they may build a cash value that you could possibly even borrow against as well. So it's a life insurance kind of with a built-in investment component to it as well. And then term life, which I think is the most common, and this is where you're simply buying coverage for a fixed period of time, often 10, 20, or 30 years. This tends to be less expensive for younger purchasers because the odds of passing away when you're young are pretty low. If you're 70 years old and you walk in to buy a 20-year policy, they can be quite expensive. So different times of these would be different as well. Let's talk about disability insurance or disability as well. So disability might prevent you from working, might increase your medical costs. Social Security does have a disability component in addition to kind of the retirement component that we regularly think of. You can also go out and purchase disability insurance as well. So just to kind of wrap things up, some things to think about, there's kind of a couple different steps to managing risks. The first thing is to try to minimize and avoid risk where you can. Second is prepare for it. So again, that's like having maybe some savings around or having a plan in place if you're unable to harvest a particular year. And then the final step, which is to transfer some of that risk to others. And insurance is typically how we do that. So those are kind of the three steps. So if you have a chance to think about your operation and where the risks are, managing some of these can make sure these non-ag things don't impact, the successful ag business that you've been trying to build. With that, if you do have further questions, please feel free to send me an email or give me a call. I'll be more than happy to visit with you about some of those things. So hopefully these risks don't come up in your operation, but if you do, hopefully you're prepared to manage those. So have a great day.